Right now, as we speak, the market is live, and Beyond Meat, ticker symbol BYND, is trading at exactly 0.9577 US dollars per share. We are witnessing a decline of approximately 1.84% regarding today's intraday movement. The stock is currently fighting to hold its ground just pennies below the critical $1 psychological threshold, a dangerous zone that often signals distress to institutional capital. Watching the tape this morning, we see the price oscillating in a tight range, having opened at $1.01 and quickly succumbing to selling pressure that pushed it down to a low of roughly $0.9565. The volume is already ticking up, sitting around 18 million shares traded, which suggests that the battle between the remaining bulls and the aggressive shorts is heating up as we move through the morning session on this Thursday, November 20, 2025. When you see a stock like Beyond Meat trading at these levels, the immediate expectation for many retail investors is that this represents a massive discount on a brand that is a household name. The general assumption is that a company with products in grocery stores worldwide and partnerships with major food chains cannot possibly be valued at under $1 for long. People expect a rebound, a recovery, or a return to the glory days of 2019 when this stock traded above $200. However, the reality is far more complex and, frankly, much more severe. The reality is that we are not looking at a simple market dip, but rather a fundamental restructuring of the company's entire capital base. The market is pricing in a scenario where the equity holders, that means you, if you hold shares, are at risk of significant dilution or further value erosion due to the massive debt load the company is trying to manage. While the brand is visible, the balance sheet tells a story of a company in survival mode, not growth mode. This disconnect between the visibility of the product and the viability of the stock is where the trap lies for the uneducated investor. Let us look closely at the mechanics driving this price action right now. One of the most critical factors you need to understand about Beyond Meat today is the short selling activity. This is not just normal market ebb and flow, this is a battleground. Current data indicates that the short interest as a percentage of float is hovering near an alarming 37%. To put that in perspective, anything above 10% is considered high, and anything above 20% is extremely high. Beyond Meat is sitting at nearly double that extreme threshold. This means that more than 1 in every 3 shares available for trading has been borrowed and sold short by someone betting the price will go lower, potentially to zero. But here's the deeper insight that you might not be seeing on your standard brokerage app. The days to cover ratio is currently sitting around 14. This is a massive number. Days to cover represents how many days it would take for all the short sellers to buy back their shares to close their positions based on the average daily trading volume. A ratio of 14 implies that if a catalyst were to spark a rally, the short sellers would be trapped in their positions for 2 weeks of average volume, creating a massive backlog of buy orders. This setup is a classic powder keg. However, you must temper this excitement with the borrow fee rates. The cost to borrow these shares to short them is fluctuating around 26% annually. Institutional shorts are willing to pay that exorbitant fee because they are that confident the stock is going down. When you see smart money paying 26% interest just to bet against a company, you have to pause and ask yourself what they see that you might be missing. They are betting on a liquidity crisis or a restructuring that wipes out common equity. For those of you watching this, I want you to comment below right now with your honest assessment. Do you think the short sellers targeting Beyond Meat are predatory vultures destroying a sustainable company, or are they simply the rational cleaners of the market identifying a failed business model? I really want to see the debate in the comments section because this is as much a philosophical battle as it is a financial one. We also need to discuss the failed to deliver data. When short selling is this aggressive, we often see spikes in fails to deliver, which happen when a seller does not deliver the securities to the buyer within the standard settlement timeframe. In October, we saw millions of shares in fails to deliver, which can sometimes indicate naked shorting or simply a lack of available shares to borrow. This creates a synthetic supply of shares that depresses the price artificially in the short term, but creates a coiled spring for the future. If regulators or clearinghouses force a buy-in of these failed deliveries, it forces buying pressure regardless of the stock's fundamental value. You need to watch the SEC's bi-monthly fail-to-deliver reports for BYND closely. If those numbers spike again while the price is under $1, we could see a violent technical move upward that has nothing to do with selling more burgers and everything to do with market plumbing. Context is vital here. We cannot talk about today's price of roughly 96 cents without addressing the elephant in the room, the massive volatility we saw just last month. In mid to late October 2025, Beyond Meat stock suddenly exploded from around 50 cents to a high of $7.69 in a matter of days. This was an increase of over 600%. It was fueled by a perfect storm of rumors regarding a distribution deal with Walmart, inclusion in a meme stock ETF, and retail traders on platforms like Reddit and X coordinating a squeeze. For a brief moment, the expectation was that Beyond Meat was back. But look at the reality. That rally collapsed almost as quickly as it started. The stock fell from over $7 back down to the $1 level in weeks. This is a textbook bull trap. Investors who chase the momentum at $4, $5, or $6 are now holding heavy bags, down 80% or more on their position in less than a month. This creates a layer of overhead resistance. Every time the stock tries to rally, these trapped investors will likely sell to get some of their money back, creating a ceiling on the price. Now, let us shift gears to the fundamental business performance, because eventually, stock prices do follow the money. The company released its third-quarter financial results on November 10, 2025, and the numbers were sobering. Net revenues came in at $70.2 million, which was a decrease of 13.3% compared to the same time last year. This is the critical metric. In a growth industry, you want to see revenue climbing. For Beyond Meat, the demand is shrinking. The novelty of plant-based meat has worn off for many consumers, and inflationary pressures have pushed shoppers back toward cheaper animal proteins or simple staples like beans and lentils. The reality is that the company is shrinking, not growing. Even more concerning was the bottom line. The company reported a net loss of $110.7 million for the quarter. While a large portion of this was due to non-cash impairment charges, essentially writing down the value of assets that are no longer worth what they used to be, the cash burn is still a major issue. The company is losing money on every burger it sells when you factor in all operating costs. The gross margin was a mere 10.3%. In the food industry, where margins are already thin, 10% is perilously low. It leaves almost no room for marketing, research, or administrative costs. This financial deterioration is why the stock is trading under $1. The market is looking at that cash burn and the 13% revenue decline and doing the math on how long the company can survive without raising more money. This brings us to the topic of debt and restructuring, which is arguably the most important piece of the puzzle for anyone holding this stock. In October, Beyond Meat engaged in a restructuring of their convertible notes. They managed to reduce their total debt load, which sounds good on paper. However, the terms of these deals often involve giving bondholders a significant amount of equity or the right to convert their debt into stock at lower prices. This acts as a dilution machine. Every time debt is converted into shares, the slice of the pie that you own as a common shareholder gets smaller. The recent price action reflects the market's fear that the only way out for Beyond Meat is to print more and more shares to pay off its creditors, effectively drowning the existing shareholders in a flood of new supply. Retail sentiment on this name has shifted dramatically. If you browse the forums on Reddit or look at the conversations on X today, the mood has swung from euphoric hope during the October rally to bitter resignation and anger. Many investors feel burned by the volatility. There's a strong contingent of hodlers who believe in the long-term mission of saving the planet and reducing animal agriculture, but they are finding it increasingly difficult to reconcile that moral stance with the destruction of their financial capital. The debate has moved from when moon to will they declare Chapter 11. You must separate your emotional connection to the product from the cold, hard calculus of the balance sheet. Let us look closely at the future outlook and the scenarios that could play out over the next 6 to 12 months.
The most immediate risk is the NASDAQ listing requirement. The NASDAQ exchange requires companies to maintain a minimum bid price of $1 per share. Beyond Meat is currently violating that rule. If the stock stays under $1 for 30 consecutive business days, they will receive a deficiency notice from NASDAQ. They will then have 180 days to regain compliance. This usually leads to a reverse stock split. This is where the company consolidates shares, for example, exchanging 10 old shares for one new share to artificially boost the stock price back up to the $10 range. While this keeps them listed, it's historically a bearish signal. Companies that reverse split often continue to fall post-split because the underlying problems haven't been fixed. If you are holding shares, you need to be mentally prepared for a reverse split announcement in early 2026 if the price does not recover organically. Another scenario is an acquisition. For years, rumors have swirled that a major food conglomerate like Kraft Heinz, Nestle, or Tyson might buy Beyond Meat. At a market cap of roughly $450 million, the company is now cheap relative to its historical valuation. A large player could buy the brand, strip out the administrative costs, and plug the products into their massive distribution networks.